introduce, we would like to take this opportunity to humbly welcome you to this annual general meeting of Greenpiece Global Limited, the leading producer of roses globally.
The purpose of today's meeting is to review strategic, operational and financial performance indicative of the firm's functionality and growth as an entity. The protocols of today's meeting are as follow: an overview of principal investments, an overview of financial performances, and ultimately a critical evaluation of decision-making process employed.
The initial business investments made were calculated and precautious. Out of the initial capital on hand, roughly 10% was spent on both marketing, research and development respectively per quarter. As for the initial investment in plant and equipment, $7,000 was allocated. This allowed for the firm to successfully meet demand that was generated by the former.
The burn rate had to be constantly monitored, as permitting it to be too high would incur unnecessary high costs, while permitting it to be too low would result in not fulfilling the production levels needed to meet demand, and thus would restrict revenue growth. Subsequently, 12% of the company was given to employees, and 16.5% stake was sold to investors. As a result, there was roughly $5,500 left in cash in hand, which comprised of $3,000 remaining from initial capital, and $1,650 acquired from the sale of shares to investors. This was kept as a buffer to complete any imminent transactions that subsequently may have needed to be carried out.
Due to the sensitive and volatile nature of the rose industry, all following decisions were made with great precaution and care. Once the flow of inputs and correlating outputs became less erratic, it became possible to implement an evolved strategy. Our unique strategy entailed the decision to keep all investments in marketing and research and development relative to the outputs of the firm, hence not investing huge initial amounts, presumptuously hoping to see a demand jump. In this sense, our revenue figures were the main indication as to how much we should be spending on each variable input. Once the daily revenue figures started producing lower marginal increases, it was indicative that further investment would be required. Our increase in plant and equipment was determined by our burn rate. Upon observation, it became increasingly apparent that past a certain percentage, in our case 75%, it was more suitable for us to invest in new plant and equipment. This is the incurring cost of running a machine past 75% would be too high. Rather, with sufficient cash in hand, it would be possible to increase the capacity of plant and equipment and run it at a lower cost. Financial results attained over the period of the 8 quarters of trading are an accurate exemplification of the effectiveness of the aforementioned business decisions. Figure 1 is a portrayal of the effect imposed by the increments of both marketing expenditure, research and development expenditure on total revenues. As you can clearly see from the graph, both research and development and marketing expenditures were both increased at a fairly similar steady rate. However, revenue figures increased significantly with healthy upward trend. Figure 2 is a portrayal of the effect imposed by increments of both marketing expenditure and research and development expenditure on net profits generated. The graph illustrates that again both research and development and marketing expenditures were both increased at a fairly similar steady rate. However, the somehow erratic movements within the net profit line are a result of 2 factors. Factor 1 being high injections in expenditure of both marketing and research and development, resulting in substantial operating cost increases and thus temporary slumps in net profit figures. Factor 2 being the fact that full capacity had been reached and there was a time lag until burn rate was adequately amended.
The ratio of sales made to operating profit generated showed a declining trend. This is as sales increased, so did costs, hence decreasing operating profit. The gross profit margin stayed consistent at 90, signifying that the operating costs stayed consistent, 10% of revenues throughout. Return on shareholders' funds saw a decrease from 81.44% to 59.69%, as the owner's stake was diluted over time in order to bring aboard additional shareholders. The average net settlement time trade payables and receivables was relatively balanced, indicating that Greenpiece was not reliant on incurring debt.
These figures indicate that the ratio between sales revenue to capital employed ameliorated and peaked in quarter 2 and started to drop again. This represents the trade-off undertaken while increasing the capacity of machines to decrease the running cost, burn rate. Figures show that a peak occurred in quarter 2, as the initial injection in capital produced a proportionately higher revenue than subsequent capital employed. As such, the law of diminishing returns was evident. Records show that current assets grow at a higher rate than current liabilities, permitting adequate means to pay any obligations. Similar to the current ratio values, quarterly acid test ratios denote an increasing ability to cover immediate liabilities using short-term assets without selling inventory.
Further analysis was conducted through the use of a 5-step DuPont model. From the first quarter to the second, return on equity experienced an inflated increase from 15 to 34%. This large increase was expected as net income levels dramatically increased over the period of time. Return on equity gradually decreased, indicative of a slower rate of increase of net income but a slightly faster rate of increase of shareholder equity.